is an engulfing candlestick? Well, it basically explains itself in the name. It's a candlestick in the opposite color of the previous candle, and it simply engulfs it. A bullish engulfing candle opens at or is lower than the previous candle's close and closes above the previous candle's open. So basically being bigger than the previous candle on both sides, making it look as if it's engulfing it. Let me show you an example. So here we found a pretty strong support where price bounced off it multiple times, telling us it really respects it. We see the price comes back down to the support. We can expect it to bounce back up, but before entering, we need a little more confirmation rather than just assuming the support will hold. That's when we see a bullish engulfing candle. It completely engulfs the previous red candle and is exactly at the support. This is an extremely bullish sign, and we can be pretty confident the price will go up from here. So we enter the trade and look what happens. Now, it's also important to note that just because there is a bullish or bearish engulfing candle doesn't mean the price is going to reverse in that direction every time. You shouldn't be just trading purely off candlestick patterns. You should be using them as almost if they were hints on which way the market is about to go, not pure decision makers. You should be using other tools with candlestick patterns like support and resistances, indicators, different strategies, etc. So just to be clear, just because you see a bullish engulfing candle doesn't mean the price will go up from there, but it can be a good indicator that the price will head in that direction. Let me show you a bearish example. So here we have the same type of setup, a strong resistance where the price respected it multiple times before, and we see the price comes back up and starts to slow down, giving us a bearish engulfing candle, completely engulfing the previous green candle. We see that it got rejected at the resistance and there was a bearish engulfing candle, indicating this is a good sign to go short. And look what happens. Price goes down. Next, we have the momentum candle. The momentum candle is a lot easier to spot than the engulfing candle, purely because of its size. A momentum candle is simply a candle that is 2 to 3 times bigger than the previous candles before it. This candle can be insanely powerful because most of the time, after it happens, the price will continue to go in that direction, making this point a great time to enter. The most efficient and effective way to use this candlestick pattern is in choppy markets, where the price is moving sideways. If you ever see a sideways market, then a huge momentum candlestick appears, being 2 to 3 times bigger than the previous candles, you can be pretty certain that the price will continue in that direction. Why is that? Well, think of it like this. Whenever there is a sideways market like this, there are a lot of shorters stuck in their trades. They don't want to exit their trade yet because the price is moving sideways and it can honestly still move in either direction. They draw their support and resistance and set their stop losses right above the support. So that means there are going to be tons of traders setting stop losses all over this area. Meaning, if there's a sudden price movement and price hits this liquidation zone, all these stop losses will be hit, just adding fuel to the fire for this price to keep moving up. Also, when price breaks a choppy market like this, it'll usually start a trend in that direction. It's the same type of strategy with shorts. If there's a choppy sideways market and you see a huge red candle 2 to 3 times bigger than the candles before it, this is a great indicator to enter a short position because it's likely the price will continue to move downwards. Next, we have the multiple candlestick pattern. This is one of my favorites as it usually holds pretty true on charts, and it's also pretty simple. All it is when you have 3 or more candles that have wicks going in one direction. The more candles, the better. I like to pair this candlestick pattern with support and resistances. So look at this chart. What do you see happening? Well, for one, we have a key support where price bounces off multiple times. Then we have multiple candles with wicks going downwards, exactly at the support. As you can see, all these candles have downward wicks, telling us that sellers are trying to break this support, but buyers keep fighting them off and are winning multiple times, confirming that this is a key support and price has a good chance of bouncing upwards. As said before, the more candles, the better the probability the price will respect that pattern. Let's go over a short example. Price moved to the resistance. There are multiple candles candles with wicks heading upwards, telling us that price really doesn't want to move up from here, giving us a good short entry. So we enter here expecting price to reverse from this point, and look what happens, it does. Next we have the doji candle. The doji candle is a candlestick with a very thin body and it has wicks on each side. Why this one is so important to understand is because it can be a great indicator on when the price is about to reverse in a direction. What this candle basically represents is the market is uncertain on which way it wants to go and is having resistance. Whenever there is uncertainty or resistance, the price will more often than not head in the opposite direction. Let's see an example. So here we have price moving down pretty hard. Then a green candle appears and it just so happens to be a doji candle. This is telling us that sellers are starting to be less confident and buyers are starting to enter, making this point a great potential place to enter. What I normally like to do with doji candles is after I see one, I'll wait for 2 or more candles the same color to confirm that the price will reverse. So in this example, I see a green doji candle. I wait, see 2 more green candles heading upwards, telling me I can be confident that the price will continue in that direction. So this is the point where I enter the trade and boom, the price goes up from here. There are multiple different variations of the doji candle that you might see. There's the regular one, which is the one that we just talked about in the last example. The long-legged doji candle, which is basically the same candle but just has larger wicks. The dragonfly, which has a small body and a big bottom wick. Then the gravestone, which has a small body and has a big upper wick. All of these tell the same exact story, a reversal in price. The next candlestick we'll be looking at is the hammer. The hammer is usually a candle that looks like this, a decent sized body and a long wick. What this candle is telling us is that sellers got the price all the way down to here, but the buyers absorbed all that selling pressure and raised the price all the way back up. This is usually an extremely bullish sign and can tell us that the market will continue to go in that direction. A candlestick that is very similar to the hammer is the shooting star. The shooting star is just like the hammer, but it has a small wick on the opposite side. You should be playing this just like the hammer, where if you see a shooting star candle like this, you can have a good suspicion that the price will start reversing. This next candlestick pattern is called the tweezer. This pattern is a red candlestick followed by a green candlestick, both having similar wicks on the bottom. If you see this pair, you can have a pretty good idea this chart is about to move upwards. Let's see an example.